the recording. Again, welcome. I am Melissa Adams, Programs Manager at the Mass Department of Agricultural Resources. Welcome to the Financial Foundations Workshop for Massachusetts farm owners and operators. This is being offered by MDAR's Agricultural Business Assistance Program. And I would now like to introduce Ray Belanger and Jacqueline Mastrangelo from Fish Park Consulting, who are our instructors today. They both have an extensive financial background and work with farmers across Massachusetts, analyzing their current financial state, training them on how to review financial statements and how to prepare a budget utilizing valid assumptions.
Thank you, Melissa. Thank you, Jess. Welcome, everybody. I'm glad so many people showed interest in tightening up your financial records on your farms. Jacqueline and I have worked with many farms, as Melissa indicated, of all sizes utilizing all types of financial records. So yes, we've seen the shoe boxes and we've seen the very well launched and utilized QuickBooks setups and everything in between. So why do you want to even consider tightening up or improving how you're gathering, storing financial information, and the output being good financial statements, good financial records? There are many reasons. You're going to be much happier at tax time if you have a good set of records, because those of you using a computerized system will find that at tax time, you're going to click on reports, click tax report, and if everything had been entered properly, it's going to be a lot easier to file your taxes. And taking out the shoebox, putting receipts in piles, that can be very labor intensive. It can make things very anxious at tax time. Insurance purposes, it's so sad when you see a disaster somewhere and you see farmers that are being shown on the news that cannot get help because they cannot prove their losses. So again, come the time of filing an insurance claim, you're going to be well served if you have good financial records. Also, the cost of premiums can be influenced by your financial records. Probably the best example there is workers' comp insurance, where you have to show revenue and you have to show payroll, and that directly affects the premium you're paying. Certainly banks look for regular reporting of financial statements. Those of you who have borrowed, some of you may have to, depending on the amount borrowed, turn in your financial statements every month. Some of you may have to do it quarterly, and most of you probably have to provide financial statements once a year. But certainly lenders want to see a good set of financial statements. And of course, the most important reason for you to keep good financial records is so that you are a better manager of the farm business. You want to be able to, on a regular basis, evaluate, see how you're doing, see where the business is going, and make course corrections during the year, during the season, versus at the end of the year saying, gee, I didn't have a good year. It wasn't as good as I thought. It's kind of late to make a course correction, at least for that season. So again, very important for you to have good financial records to rely on as the farm owner as the farm manager. Uh, Leases, we run into prudent landlords, prudent landowners who require to see good financial projections for the farms that are already in business. They want to see good financial records. Again, I realize not every landlord is that prudent, but some are. And to be prepared for somebody that wants to see how the farm is doing financially, uh, you'll be happy you have good records. Certainly, commercial lines of credit. Some of you utilize lines of credit to try to level off seasonality. And certainly, one of the key pieces of information that lenders look at when they're looking at the commercial lines is there enough cash flowing in and out of this business um, to pay back the loan, to pay back the line? Uh, because lines of credit usually are used for seasonal purposes. So significant amounts of cash need to be available come the time you need to pay down that line. A lot of lenders want to see lines of credit paid off in full, some for 30 days, consecutive days in a year. Some require that you pay it out in full for 60 consecutive days in the course of a year. So, again, being able to analyze your cash, how it's going, how it's flowing in and out is critical to you managing commercial lines of credit. Uh, when we look at farms passing from generation to generation, uh, we take a good hard look at the financials and determine what needs to be done between the granting generation and the successor generation. What has to be done? What capital is going to be needed? Who's going to be able to earn what as they take over the farm? And certainly at liquidation or sale, analyzing the financials are very important in determining value. And certainly retirement planning, not only in farm succession cases, but in any retirement case. Has enough money been earned, and is there enough money that will be able to be drawn on for a successful retirement? So you want to be looking at a team. And during the full course, we talk about internal teams and external teams. And the external team is very important. And there can be any number of service providers that you're going to need. But at minimum, you really want to have an accountant. I'm sorry, let's go through the bullet list. An attorney who you can rely on when needed, an accountant who you can rely on when needed, not just at tax time, but during the course of the year, a bank loan officer who you've introduced yourself to, even if you're not borrowing money yet, a bank loan officer who you can bounce ideas off of and will know you when you are ready to borrow. And then if you're doing well, hopefully you have a financial planner in your corner to make sure that you're setting up investments correctly, you're setting up uh, pieces of assets in the business in the correct way that's going to help further down the road. And you want a good insurance professional in your corner. So, at minimum, you want those people on this external team. You'll have other technical assistance providers, um, very technical agricultural technical assistance, all the way to general consultants like Jacqueline and I who help with general business planning and financials. Okay, some basic thoughts. And Jacqueline's going to go into this in a little more detail. In fact, I'll hand it over to her right now. But these are some basic thoughts to think about when setting up your accounting system. Jacqueline?
Thank you. Yes, so regarding your accounting software, there are different options out there for you. We know some, still use pen and paper, which is also a fine approach. But going more technical, we see a lot of farmers that we work with use QuickBooks. And it does seem to be very user-friendly for most. There's the online option, which allows you to be able to sign in from multiple places versus the desktop version that has to stay on one computer. So the online version is definitely where people are leaning more towards now these days. And when looking at creating your accounting software, the initial setup is very important, such as creating your chart of accounts. You want to make sure the chart of accounts lines with however you file your tax return. And then in addition to how it will be helpful for you to analyze your business. So when it comes to setting up your revenue streams, how you want to break that out according to your farm, and how it will help you when analyzing your financials at the end of the year in order to make specific business decisions. And you want to make sure to stay consistent. So when setting up your chart of accounts and where you're recording all of your sales and expenses, that you are recording them to the same accounts throughout the year. You're able to make sub-accounts, which is helpful to get into more detail. And then you're able to run the reports of all different ways. So you can run them to show the detail, and you can also do a more summary view, which sometimes the accountant will use when preparing your tax return. And I'll hand it back to you.
Okay. And to reemphasize that a bit, choosing a chart of accounts that mirrors your tax forms is so handy at tax time. For example, if you're filing a Schedule F, you have a line for supplies. There's a category, a line on the F, supplies, and we'll go to a farm and they're calling it, stuff to use in the greenhouse. Well, why do that when there's a line that says supplies? So think about making it easy on yourself. And again, as Jacqueline said, to stay consistent, choosing a chart of accounts on your system that's going to mirror the tax form that you're filing. And those categories and subcategories. The thing about QuickBooks, you're going to find it's almost unlimited, the number of categories and subcategories you can track. But we're always telling farmers when they keep going, adding categories, the question we'll ask them is, how are you going to use that information? So if you have the category of, we want to know we're tracking how many yellow mums we sell on a Tuesday that falls under a blue moon. If there's some reason you want that information, fine. But more often than not, no one else is going to need that information. So that you would put under a subcategory versus a category. Because as Jacqueline noted, you can run more and less detailed reports. So keep those thoughts in mind in setting up your system. Okay, at minimum, and when we're working with beginning farmers and those who haven't really grown from hobby farm into a full-blown agricultural enterprise, one of the first things we tell farmers in the beginning stages, and that beginning stage can be anywhere from the first year to 10 years out, but maintain a separate checking account. Okay, if you have a separate checking account for business operations and you record all revenue coming in and you record all expenses being paid in that checking account, you already have a pretty decent accounting system. And then putting that operating account on QuickBooks helps you upgrade your accounting function. But a good separate checking, and the reason we emphasize that, if you formed an entity, then you're required by regulation to maintain entities' financials separate from your own. But if you're a sole proprietor, you're not required to separate your personal from the business financials. So just because you're not required does not mean you should not. So we're always emphasizing separate, even though it's not mandated for you because you're a sole proprietor, separate. Keep it separate, the operating account for the farm enterprise versus personal. And again, recording everything in that one account will make it a lot easier for you to enter that data into a system that's going to give you good financial statements. And when you set that up in a software system, at minimum, you'll want that system to generate a balance sheet, an income and expense statement, and sometimes you'll hear that called a profit and loss, or you'll hear it shortened to a P&L. Those all mean the same thing, and a cash flow statement. So those are the statements you want at minimum. Obviously, there are many, many more. There are accounts payable reports. There are accounts receivable aging reports. There are payroll reports. There are many, many other reports that you may be building in a good accounting system. But at minimum, you want to be able to generate those three. So, what's a balance sheet? A balance sheet shows your assets. What are assets? Assets are what you own. So you own the land, you own the buildings, you own the equipment, you own the herd, you own the orchard. Everything that you own is an asset. And those assets can be either tangible or intangible. I just listed off examples of tangible assets. Some of you may have intangible assets. You may have proprietary property. You may have logos that you have trademarked. You may have things that you've copyrighted. You may have bought an existing agricultural enterprise and you bought the goodwill of that business. So you could have these intangible items that have a value that would also appear on a balance sheet. On the other side of the balance sheet, you have liabilities. So this is what you owe. So the loans you have, the mortgage on the farm, if there's a mortgage, the tractor loans, if there are tractor loans, credit card debt, uh, anything that you owe. And the difference between everything you own and everything that you owe is your equity. And your equity is how much of the farm you really own. So think of it as a lot of us own homes and we say we own a home, but oftentimes many of us have a mortgage on the home. So if we have a $200,000 home and we have a $150,000 mortgage on it, well, we own 25% of the home. The bank owns the other 75%. So we have 25% equity in that home. Same on the farm. Overall on the farm, how much equity do you have in that enterprise? And that's going to be very important uh, when you're borrowing, because lenders are going to look at, what piece of the pie do you own? Or is it all owned by people you owe money to? And that's going to differentiate those of us who we work with farmers where, okay, the tops they can borrow on that seasonal line of credit is $50,000. And then farmer B can borrow $500,000. And then farmer C can borrow $5 million on a line of credit. And what dictates that significantly is how much equity they have in that agricultural enterprise. What is their net worth at the end of the day? What piece of the pie do they own? And how sizable is that piece? And that's going to drive borrowing ability, especially in lines of credit. Okay, here is a sample balance sheet. And on this balance sheet, we've listed what are called current assets. Current assets are either cash or easily convertible to cash. So in this example, we're showing 10,000 in cash. We're showing 20,000 in accounts receivable. So accounts receivable, that's money owed to you. So were you selling product to school systems? Are you selling product to restaurants? And do they owe you money? Are they going to pay you in 30 days, for example? So accounts receivable are a current asset because those are going to be converted to cash fairly quickly, and you can convert them. Usually you have control over converting them more quickly because you can offer incentives for them to pay you earlier. Likewise with inventory. We're assuming your inventory isn't stale inventory, but it's good inventory that could be converted to cash by selling it, having a sale, having a special, whatever. So current assets in this example are $45,000. And then your fixed assets, things like equipment, vehicles, tractors, land. In this example, we're showing 120,000 in equipment and vehicles and 200,000 in land. And then we're showing the herd having a value of 60,000. We're showing buildings and improvements on those buildings totaling 75,000. Fixtures, furniture, office furnishings in the building, 5,000. Going further, computer equipment, software, phone systems, 15. So we're showing fixed assets of 475,000. And then we'll talk a little bit about depreciation later, but depreciation is expensing an asset over time. So, for an example, we plugged in a nominal amount of depreciation of 5,000. So that gives the value of those fixed assets on the balance sheet as being 470 versus 475. Okay, and you could have any number of other assets. Some farmers have life insurance with a cash surrender value. We're showing 5,000 here. There could be any number of security deposits. We're showing 1,000 here. And again, we're showing goodwill and patents on this intangible assets of 200,000. So total assets less the total liabilities. I'm sorry, total assets are 721. Next slide, I had to break it up so you could read it. I'm used to it being on one slide. So after we take out the liabilities, and on this sample, we're using current liabilities, which are items that are going to be paid over the next 12 months. So accounts payable are the bills in the drawer that are probably due over the next 30 days or so. Credit cards that are due, payroll taxes that you've probably withheld from employees that are due. So we're showing total current liabilities of 19. We're showing mortgages of 150, some equipment loans of 75. So now we're at total liabilities of 469. When we minus that from the assets, we get owner's equity of 252. So this farmer who had assets of nearly $750,000 has equity of roughly a third of that, of $250,000. So that farm is in good shape when it comes time to look for financing, okay? Versus a farm that may have more liabilities than they have assets, that becomes problematic when it comes time to borrow, or versus those that are highly leveraged, where everyone else owns 90% of the farm and they only owe 10%. So again, this example we showed you with equity of roughly 30%, this farm would be in good shape come borrowing time. So that wraps up the balance sheet. And that gives you an idea, hopefully, of how valuable having a balance sheet is. Now, that's going to require you to be keeping a list of everything you own and entering it into some sort of system, whether it's in your manual system or whether it's in the computerized system, or whether your accountant is going to handle the system. You need to make sure the accountant knows what you buy, how much you paid for it, and the other key piece of information they'll need is the date you placed it in service, because that's going to become important at tax time and for depreciation, whether you placed it in service December 30th of 2024 or January 2nd of 2025. So if you're not already tracking what you're purchasing, how much you're paying, and the date you're placing it in service, start doing that, even if it's a manual notebook and more ideally in a system like QuickBooks. Okay, the next key financial statement is an income and expense statement. Now, let me go back to the balance sheet for a minute. The balance sheet was as of a moment in time. So think of a snapshot. When you take a photograph, it captures everything as of a moment in time. The balance sheet captures everything as a moment in time. And some of you will be looking at a balance sheet at the end of the month. Most of you will be looking at it at the end of the quarter or at the end of the year. So a lot of balance sheets get generated on December 31st because your lender wants to know what your balance sheet looked like, and more often than not, you're going to generate it on December 31st that shows on that date what it looked like, how much equity you had in the farm on that date. And the reason being, it's continuously changing. So the mail comes in and people paid some of those receivables they owed you. Receivables are a liability. Those went down, and cash in your account now went up. So things are always in flux. So you're capturing it as of a moment in time. And that way you can compare from quarter to quarter, if that's realistic for you, or from year to year, if that's more realistic for you. You're comparing, how does my equity compare this year versus last year? Is it going in a positive direction? Okay, so the income statement. And the income statement is for a period of time. So this sample was showing you is for a year. It's an income statement for the period from January 1st, 2024 to December 31st, 2024. Now, realistically, most of you are going to be running income statements either monthly or quarterly, whatever makes most sense for you, because maybe there aren't a lot of things that are going to make sense profit-wise that occur in any given month, and looking at quarterly statements is going to make more sense for you in comparing Q2 this year to Q3 last year. And then for others of you, looking at income statements every month and comparing to last year. How was this April compared to last April? How was this September compared to last September? So they cover a period, and you're going to generate these on your system, either monthly, quarterly, annually, whatever makes sense for your operation, whatever makes sense for people who are reading your financial statements. Okay. One of the things that I want to really focus on is the fact that there should be clarity between your financial statements and what you're doing. Jacqueline, if you could go back. For example, the headings on this show livestock and other items bought for resale, livestock and other items raised. So 246,000 in one category, 242 in the other, for total revenue of 869. What does that tell me? Not a lot. All it tells me is, okay, this farm is growing or raising about half of what they're selling, and the other half they're buying in for resale. Uh, that's pretty limited information. Uh, so, in setting up your system, you want to take a look at revenue streams. So, if we could go to the next slide now, Jacqueline. Thank you. So, maybe setting up your system so when you run a P&L, you have more than items bought for resale. Maybe you have a half dozen key components, and you don't want this to be an ongoing list where you're capturing absolutely every category, because as Jacqueline talked about earlier, uh, categories and subcategories are fine. So if you wanted subcategories under any of these six, but this particular farm happened to have a half dozen uh, primary categories where primarily they were buying in a lot of corn and pumpkins and honey and bedding plants and compost and mulch and fruit. Okay. And then under fruit, if you wanted to know how much was apples and how much was peaches and how much was plums, etc., fine. But those are better served as subcategories to fruit than a category. And likewise for items raised, this particular farm was selling primarily beef, poultry, pork, eggs, mixed vegetables, and mixed flowers. So again, having categories under these is perfectly fine, and often farmers, beef producers have subcategories by cuts of beef. The same with pork, uh, subcategories under everything from pork roast to bacon. Um, Vegetables, this is where you can break out how many different line items of vegetables do you want to track? And it depends on the scale of the operation. Uh, Certainly, a lot of small producers, one line item of mixed vegetables serves them well. It serves anyone reading their financial statements well, and likewise for flowers. So, again, consider some detail in the revenue streams that you're capturing. So when you're sharing your financial statements, they don't have to try to figure out what does this farm do? Because again, if it's just two line items of items bought in for resale and items raised, then, well, what are those items? So try to have clarity between what you're tracking, what you're producing for financial statements, and what's going on the farm. Next slide. Okay, so we talked about the income section of the income and expense, and now the expense section. And those of you who file a Schedule F, these probably look familiar to you because this chart of accounts from this farm, you can see pretty much mirrored their Schedule F. It goes right down in order: car and truck expense, chemicals, depreciation, employee benefits, etc., etc. It goes right down the Schedule F. And again, it just makes a lot of sense to mirror that Schedule F. You know, why call it soil amendments if Schedule F has a line fertilizer and lime? Tax time, it just makes things easier between you, your accountant, you, and your tax preparer. So these are all samples of categories from a farm we worked with on their expense categories. And I believe the next slide is going to show further categories Um, and again, you can see toward the bottom, this starts to drift away from the Schedule F because the Schedule F doesn't capture everything. And one of the things you want to try to avoid is the last item on the right side of that Schedule F says other expenses. Uh, and you don't want to have an other expense category that that shows an astronomical figure. So you can see on this, once we get beyond utilities and vets, now there are things that probably don't show up on the F, like bank service charges and merchant fees and uh, breaking out telephone and postage and travel, meals and entertainment, and keeping that miscellaneous category or other category, keeping it to a small amount. So this particular farm had $1,191 in miscellaneous expense. Okay, which isn't bad. We love when it's a small number like that or even less. Um, it can get a little frustrating sometimes when that number is $100,000 and now we have to dig and dig. Well, what were the 100,000 in expenses that you couldn't plug into a category? And more often than not, we found out it could have gone into a category, but the farmer got lazy or the accountant got lazy and just dumped it all into miscellaneous or other. And that doesn't help, especially when a lender is looking at your historic performance and they're comparing past years and they're comparing one to another. And they want to see trends. They want to see how well you're managing expenses. So are you holding the line on expenses? Are some expenses going through the roof? Is that due to mismanagement or are those external forces beyond your control? Um, so the more good detail you have in the profit and loss or income and expense statement, the better. So this particular farm, when all was said and done, showed a net profit of $19,241. And you could say, wow, this farm's doing terrible. But when we look back up, if you go to the previous slide, when we look back up, I believe we'll see a good chunk of depreciation. Yeah, $79,413 in depreciation. Now, what depreciation is expensing something over time. So buying, I don't recall this particular farm whether they bought a very expensive tractor, which would then be depreciated over 7 to 10 years, or whether they bought or whether they did significant improvements in the barn and it's being depreciated over many years. But depreciation, although it lowers the bottom line, you know, and a lender knows, well, I can add that back into, I can add that almost 80,000 to the 19,000. And realistically, money wise, I made about 100,000. So yeah, this farm was doing very well. Uh, they just had a significant depreciation deduction. And that's where it becomes very important to let your tax preparer know, let your accounting know, your accountant know. If you're your own accountant, you keeping good records of what are the assets I bought, when did I put them in service, what did I pay, and then your accountant's going to help you figure out how to treat them depreciation wise, because depreciation is a very important tax tool, a tax management tool. So again, important on knowing how to read financial statements, because instead of saying this $500,000 a year revenue farm is only making 20,000, well, no, they're not. They're doing better than that. They're taking advantage of depreciation for tax purposes. Okay. The cash flow statement. Cash flow statement, again, is very critical. Lenders especially want to know, okay, you're making money, that's good, but what does the cash flow look like? So the cash flow statement is going to show all money flowing in and all money flowing out. Okay. So it's everything on the income and expense statement, but it's plus other things. For example, when you go to the bank and borrow money and you put that in the operating account, you borrow 100,000, you put 100,000 in the operating account. I can't tell you how many times we'd see that shown as income with beginning farmers. They don't quite know yet. They haven't been on a webinar like this, and they're claiming loan proceeds as income. And of course, Jacqueline would say, and I will say, do you really want to pay income tax on money you borrowed? No, that's not income, but it is money flowing in. So it does get added. And your accountants could treat this either of two ways. Some accountants kind of merge the cash flow statement and the income statement together, and others treat them as two separate statements. But whether it's all in one or separated, typically all of the income and expense items that belong on a profit and loss or income and expense statement are typically up above, and usually the added cash flow items are typically below if they're not on a completely separate statement. And that's where they're going to show money you borrowed, grant proceeds that came in, owner's capital injection. You're operating as a sole proprietor, and you as the owner see that, gee, the farm account needs more money. And you take money out of your pocket, you take money out of your personal account, and you put it into the operating account. That's not income. You don't want to show it as income. You don't want to be paying income tax on money that you took out of your wallet and put into the farming operations. Okay. And the same with cash flowing out. When you're creating your income and expense statement, you're going to find that the only part of a loan payment that's deductible as a business expense is the interest. So principal repayment of debt is not a business expense, but that certainly impacts operations. So that shows up, the principal portion of debt repayment shows up on the cash flow statement as cash out. And if you're a sole proprietor paying yourself and you're drawing money, that doesn't show up on the income and expense statement. You would show that under the cash flow as owner's draw, cash flowing out. And then when you pay income taxes, again, that's cash flowing out, but it's not on the income and expense statement. You really don't know what income taxes are until you've finalized your income and expense statement. And now you have good data to prepare taxes. Now you find out what your tax burden is. And yes, you're cutting a check uh, out of the operating account to pay federal and state taxes, but it's not an income. I'm sorry, it's not an expense of the farm. That's after. So it's cash out showing on the cash flow statement. So that's a very important lesson to get your head around, knowing the difference between revenue and expenses versus cash flow. Okay. People often joke about talking to a farmer who, how are you doing? Good. There's money in the checking account. Um, and that may make for a humorous joke, but you really want to know by keeping good books and keeping a good income and expense statement and knowing whether you're making money or not. Certainly, knowing that your cash is positive is important, but it doesn't necessarily reflect profit and loss. So, two separate things, and both very important. So, you're utilizing these financials hopefully throughout the year. Hopefully, you're running income and expense statements. Hopefully, you're running cash flow statements monthly or quarterly, whatever makes sense in your operation, and it's helping you manage. How am I doing? How did I do this month or this quarter compared to a year ago? How did I do compared to the projections that I developed when I met with Ray and Jacqueline or whoever your business consultants are? You ran a budget, you ran some projections, you said you were going to do this amount in June of 2025. You said it was going to cost you expenditures of this amount in June of 2025. When June of 2025 rolls around and you run an income statement, how did you do compared to what you projected? So keeping good statements is going to make you a better business manager. And hopefully it's going to allow you to make business decisions during the season in real time while things are really happening and make course corrections before it's too late. Waiting till the first quarter of the following year to figure out if this year was a good year. Okay, you can make adjustments for next year, but the damage could already be done for this year. So, analyzing these statements on a regular basis makes you a better manager, a better business manager. And that's the idea. You want to be as proactive as possible. Certainly in agriculture, we fully understand there's a lot of things you have to be reactive to, but there are plenty of good agricultural operators out there in farms of all sizes that are very good at being proactive and managing what's happening and making things happening because they have good financial information. Okay, that's the cash flow statement. So those were your three primary financials that at minimum you want to be producing at minimum, you want to be reviewing as the scale of your operation dictates. And as I mentioned earlier, maybe a lender is going to be dictating how often those get looked at. And that depends on amount borrowed. When I was a commercial lender, there were clients that I met with every month to review. They were borrowing well into the millions of dollars. And there were others that I met with quarterly. And then the vast majority I met with annually, because that's all the scale of their operation required was an annual review. Okay, some of the other things that are going to affect financials are the type of entity you choose to operate under. And many farms, many small businesses in general, operate as sole proprietors. And the majority of those that operate as sole proprietors do so out of default. And what I mean by that is they never really thought about it. They just started. They started Ray's Farm and started producing and selling and never even gave a thought to how should I structure the business. So the sole proprietorship is easy. You don't have to do anything. You just say, hello, world. I'm Ray the farmer, and I have stuff for sale, and I'm operating, and away you go. Now, if I decide to call it Fish Park Farm and not Ray Belanger's farm, then I do have to do one small thing, and that's go to the town hall and file what's called a doing business as, a DBA certificate. And the reason for that, the cities and towns want to know who's running this business. And so every 4 years, I go up to Athol Town Hall for Fish Park Consulting because I'm a sole proprietorship, and give them $40 and sign my DBA certificate, and it's good for 4 years. And a lot of you are probably sole proprietors, and that's what you do. If your farm name is different from your name, you file that DBA certificate. So it's very, very simple. And that's why a lot of farms out there that we deal with are sole proprietors. And often that's just fine. It's not good or bad. It's whatever makes sense for you. And that's where you're filing a Schedule F. And then we work with some farmers that file a Schedule F and a Schedule C. So there are certain things, accountants often, we see them separating out the logging component of a farm and filing a Schedule C for the logging component and Schedule F for everything else. For the beef, the pork, the poultry, the eggs, whatever. Okay. And those are schedules that are attached to your 1040, your federal 1040, your personal tax return. So a sole proprietorship, again, very simple to form, not a lot of regulatory requirements, and fairly simple tax reporting because you're just filing a Schedule F, or some of you maybe an F and a C. Okay. The farm profit is subject to Social Security tax. Okay. And that's not a bad thing. Keep in mind, those of you, especially early in farming, in managing the bottom line, hopefully you have a good accountant and a good tax advisor who's alerting you to the fact that, okay, it's okay to take advantage of all the tax uh, concessions that there are out there. But again, the less you're paying in Social Security, the less you're going to have to draw on at tax time. So keep that in mind. And also keep in mind those of you who are husband and wife farmers, and we run into this a lot, and not a lot of accountants properly coach husband and wife farmers on the fact that they can be filing under what's called a qualified joint venture. And what that means is and you have to be married husband and wife to do it. That's why I'm not opting to be politically incorrect. Correct. You have to be married husband and wife to file as a qualified joint venture. And that's where each files a separate Schedule F. So they apportion so much, the husband takes so much revenue and expense, the wife takes so much revenue and expense. That came about because so often it was just the male in the partnership who was filing the Schedule F. Come retirement time, the wife had never paid into Social Security. Okay. That can be an issue. So ask your accountant about filing under a qualified joint venture. When you file two separate Schedule F, the apportionment between revenue and expenses has to be the same. So if you each take half the revenue, you each have to take half of the expenses. If one takes 90% of the revenue and the other 10%, the one taking 90% of revenue has to take 90% of expenses and the other 10. So it has to be apportioned the same on the income and expense. Now, we work with a lot of farmers. If you could go back to that, Jacqueline, we work with a lot of beginning farmers who have the day job, and certainly a very valid way of capitalizing a beginning farm is the tax advantage that losses when you first start, how those losses offset income earned on that day job. So make sure your accountant knows everything you're doing on the farm and that you're providing good data. And I'll give you an example. We worked with a farm a few years back, and we went to the farm, asked to see the Schedule F because we knew it was sole proprietorship. They said, "Oh, we don't file a Schedule F." Our tax preparer said, "Oh, you're only selling a couple $1,000s worth of pumpkins a year. You don't need to do one." And I said, "We just walked by a tractor out there. How much was that tractor?" And I forget, it was $30,000 or $40,000. Make a long story short, we sent that couple to a good accountant that we knew. That accountant refiled their prior 2 years' tax returns with a Schedule F and got them back a total of $10,000 in tax refunds because they had spent a lot of money reclaiming fields, building a farm stand, and buying a new tractor. And this careless accountant, tax preparer, who didn't want to be bothered preparing another form, said, you don't need to do it. So get good accounting advice, and get good advice even if you're in recent startup mode, if you still have what we fondly call the day job, because there are tax advantages. Sorry, losing my voice. Okay. A single member LLC also files a Schedule F. So, what is an LLC? An LLC is a limited liability company. An LLC is a hybrid entity. It's a hybrid. If it's a single member, it's a hybrid between a sole proprietorship and a corporation. If it's a multiple member, it's a hybrid between a partnership and a corporation. So the single member will file the Schedule F. And the multiple member will file the partnership return, the Form 1065. Okay. Now, a multiple member LLC has the option to file as a partnership or as a corporation. And that direction will come from your accountant because there are certain tax advantages. Okay. So if for you, it would be advantageous to file a corporate return, a good accountant's going to make sure you do that. Okay. But if you're filing a partnership return, entity that you form, the LLC, gives the multiple members what's called a K-1 form, and that shows them their portion of the profit or loss. And again, there are still some general partnerships out there. We don't see them too often any longer because most attorneys and accountants, when they're dealing with multiple owners, steer them into an LLC or a corporation. But there are still some general partnerships out there. And the only thing we say when we see a general partnership is, have you sat down and hammered out a written partnership agreement? Even though it's not required, it's a prudent thing to do. And a general partnership will file a Form 1065 like that multiple member LLC, and each partner gets the K-1 showing their portion of profit or loss. Okay, corporations. And most corporations that we see on farms, well, most corporations we see in small businesses are subchapter S corporations. What does that mean? It means the farmer formed a corporation and was advised to alert the IRS that they wanted to be taxed under subchapter S of the IRS code. And what that means is they have 75 or fewer stockholders. All stockholders are U.S. citizens. It meets certain criteria, and usually your accountant or your attorney sends that into the IRS. And they're supposed to do it within, I think it's 75 days of when you make that decision, but I know many have sent it in well after that without any issue. But all that does, it allows you to file a much simpler return. You can pass it through your personal tax return. So the corporation becomes a pass-through entity, and the profit or loss ends up on your personal return, and therefore you're paying whatever your personal tax rate is, and you're not paying corporate taxes. Because if you are a corporation, and there could be reasons that you and your accountant identify, because we work with some farms who are just straight corporations, what we call a C Corp, not a S Corp. And there's some valid reasons that their accountant identified. So again, that isn't anything we get involved in. That's where you are relying on good accounting expertise, good tax advice, where they're advising you what is best for you. Because it's not like one size fits all. It's not like an LLC is better than a corporation. It's not like a corporation is better than an S corporation. What you want to know is what is better for you. And your tax advisor is looking at how are you going to be treated now, not only now, but upon sale or liquidation down the road. What's going to give you better tax treatment? So again, getting good tax advice is critical. So it's usually important for you to align yourself with an accountant that has a decent knowledge of agriculture. Because again, you don't want to be like that couple that was told, don't bother because, that accountant they were dealing with just did not realize how much it costs to reclaim a farm and what impact and what offset that was going to have on what this couple was earning in W-2 wages. Okay, again, I already mentioned the conventional corporation. This is where you just don't take the selection, and that's some reason that your accountant has figured out is particular to your circumstances, and you just filing as a straight corporation makes sense. Even though now you're filing a separate corporate return, so you have something added there. This becomes important when you're forming multiple entities. So let me talk about that for a minute. Oftentimes, when we're working with, and they don't have to be huge farms, but very diversified and farms that are probably doing quite well, we'll run into there are many entities on the farm. And what has happened is their advisors have put them into an LLC that owns the real estate, for example. Another LLC or a corporation that owns all of the big equipment. An LLC or another corporation that owns the operations, which means they own all the supplies and the inventory and the farm stand and the cash register and the things to operate the farm, not the big equipment and not the land and the buildings. So what they're doing is they're putting things into compartments to insulate from liability. Now you have to be doing okay, at least, because now you're into multiple entities that you're paying multiple annual fees on. You're looking at multiple tax returns. So we deal with some larger farms that are paying a lot of money every year just in tax return preparation because they have so many different entities that taxes are being prepared for. But as your farms grow, keep that in mind and get good advice as to when you start to put things into different compartments. Now, we've been talking a lot about these entities, and the reason you're doing it is to protect you from personal liability. But typically, an entity shielding you from personal liability doesn't really materialize until you have employees. Because one of the things you want to ask your attorneys and accountants about is, okay, can I shield myself? Can I shield myself from my own negligence? And the answer is going to be no if you're getting the correct answer. So if you're doing all the work, forming entities doesn't necessarily protect your personal assets. Certainly, as you bring on employees and more employees, it becomes more and more critical to take a look at insulating your personal assets from attack by someone suing. And that's why breaking things out into different entities can make a lot of sense. But again, now you've got a lot more accounting expense because now you're apportioning revenue and expenses across different entities, and that can get very complex and can really rack up the accounting fees. So make sure you're getting the protection that you need. And of course, your first line of defense when it comes to liability is operate honestly and ethically. That goes a long way. Have proper insurance. I know none of us likes to pay insurance premiums, but have proper insurance. But not all insurance claims get paid, so maybe having an entity or entities to protect personal assets makes a lot of sense. So good tax and legal advice is needed. Okay, let's look at fixed and variable expenses. When we looked at the income and expense statement, we didn't talk about the cost of goods sold line, and that was intentional. I skipped over that because I wanted to go into some detail on fixed and variable expenses. So here we go. Fixed expenses. Those don't change with the number of units you're selling. So no matter how many pounds of beef, no matter how many bushels of vegetables, no matter how many trays of bedding plants, the number doesn't change. And examples of that would be the loan on the farm, the mortgage on the farm. The bank wants to be paid principal and interest every month. I'm not going to call you and say, gee, we know we had a drought, so you know what? Don't send us your mortgage payment this month. That's a fixed expense. Your insurance agent wants their payment that month. Doesn't matter how much you sold or not. So you have any number of fixed expenses, your utilities, your telephone. We can go on and on. You have a lot of fixed expenses. You have to pay the phone bill, whether you sold this many bushels of corn or that many bushels. Okay. Don't get confused with fixed versus variable expenses as being expenses that could vary from month to month. Certainly, utility bills could vary. That does not make them a variable expense. It's fixed. You have to pay it no matter whether you sold this many bushels or that many bushels. Now, certainly, we could talk about utilities are going to be affected by volume, but it's still a fixed expense. It's not classified as a variable. Okay. And variable expenses, those change with sales volume or production. Now, most farms, and here in Massachusetts, we don't work with industrial farms. And I'm sure on industrial farms, they track a lot more variable expenses. But most farms that we deal with are tracking expenses that aren't necessarily tied to a specific product. So we don't deal with farmers who are tracking the cost of tomato seeds versus the cost of pumpkin seeds. So variable expenses that we're dealing with are usually in the value added products. So the variable expenses are if you're selling jams and jellies, how much was the jar, how much was the label, and yes, how much was the fruit that the other component of the farm sold you. So what were the raw ingredients, the raw materials, what was the packaging, and depending on the scale of the operation, maybe you're allocating direct labor to the value added product line. So all of those expenses are changing with volume. So whether you're selling 100 jars of jam or 1,000 jars of jam dictates that you need 10 times more raw product from the farm, from the production component of the farm. You need 10 times the jars, 10 times the labels, and you probably need 10 hours, 10 times more man hours on the production line. So the variable expenses vary with sales or production. And break even is the point at which your revenue, your total sales, cover all of those fixed and variable expenses. And we show an example here. You're selling a jar of jelly for $10. It costs you $5.50 for the fruit plus other raw material going into that jar, for the jar and for the label. And if you're allocating direct cost of labor on the production line, then that would be in that number too. That comes to $5.50. Okay. So if you're selling it for 10, that leaves $4.50. That's called the contribution margin. And what that means is that's money that's left from the sale to contribute to paying the fixed expenses and hopefully profit. So if the fixed cost of this farm are $1,350 a month, and a lot of you are saying, yeah, I wish my total fixed costs were $1,350. I'm sure they're more than that, but we want to keep this example simple. So if you take $13.50 per month fixed cost divided by 450, that means you have to sell 300 jars of jam and jelly. Okay. Selling 300 at $10 is $3,000. So now when you sell jar number 301, you start to make a profit. I can't tell you how many farmers we worked with, and we went over this very simple exercise, and they say, "Oh my God, I wish I knew that before I started producing those value added products," because oftentimes they have no idea how much it's going to take to make a profit. And they just get so excited. It's fun, at least initially, making some of these value added products. But is it going to be a profitable enterprise on the farm? And analyzing your cost is so important. And this relays further of knowing your costs not only on value added products, but when you're buying in products for resale, having a good handle on that. And again, in the example we just talked about, if it takes 300 to break even, then you have to figure out how much money do I want to make if I'm going to go into the jam and jelly business. And the next slide. If you want to make $900 a month profit, well, here's the math. You need 200 more units. So you're selling 500 jars a month to make $900. So now you have an idea. Does it make sense to go into this product? Does it make sense to go into baking bread or baking pies or making sausage or making jam and jelly, whatever the product is? Okay. So cost of goods sold in the case of making product is what it costs you to make that product, the direct cost. Cost of goods sold in the retail component of the farm, where you're buying in from other farms to sell in your farm stand, cost of goods sold is simpler. It's your inventory. So knowing your cost and knowing most farms we're dealing with are trying to target an average of 50% gross margin on what they buy in to resell. So that means whatever they're selling for $1, they paid 50 cents for. And that varies. Sometimes it's 60-40, sometimes it's 70-30. But a good target for most of the farms we work with is a 50% gross margin. So can I, on average, buy in product for 50 cents and sell it for $1? Or those of you selling bottled water in your farm stand, you're buying it in at 10 cents and selling it for $1 or $1.50. So that helps boost the overall margin. But knowing that gross margin is important. The cash flow cycle, we talked about cash flow. And again, lenders, I spent many years in banking. I spent many years as a commercial loan officer. And I can tell you that commercial loan officers zero in on the cash flow statement. You know, they have a saying, cash is king, and they want to know, does this farm have enough cash flowing through at any given time to handle its obligations. So you want to have a handle on the cash flow cycle. So those of you buying in product to sell, you're buying it. Maybe you're buying it on account. Maybe you're paying farmer B, C, and D 30 days later. You're selling it in your farm stand. You're collecting cash. Then you're going to pay the other farms you bought from or the supplier. You're going to pay them for what you bought in. And you're going to then purchase more on account, sell it, collect, and it goes in a cycle. And the cash hopefully never stops. The cash flowing through the farm operating account hopefully never stops. When it stops, you're in dire straits. Next slide. Okay, there's any number of ratios you can look at to make you a good financial manager of your farming operation. And as your operation grows and as your accounting system becomes more sophisticated, and again, it depends on the scope of your operation. And the sooner you start getting more formalized in any degree of accounting, the better. So again, as your inventory grows, as your inventory gets more complex, as your farm stand, your on-site farm store grows and grows, certainly tracking inventory becomes critical. So now this is another financial statement. Inventory, running reports on inventory, and you taking a look at the inventory turnover. So again, in the retail environment on the farm, cost of goods sold is the inventory. So we're using an example here that the cost of goods sold in the farm stand on this farm over the course of the year was $390,000. Okay. Average inventory in any given month was $30,000. So when you divide 390,000 by 30, that means the inventory turned over 13 times a year. So when you divide 365 days by 13, 28 days. That means product was on your shelf an average of 28 days. Now, is that good or bad? Obviously, it depends on the products. So different product lines are going to have different inventory turns. So what this little exercise does, it helps you figure out, am I turning inventory quickly enough? Is 28 days good for whatever this product line was that this was an example of? Accounts receivable, again, as you're building your accounting system, as you're selling to wholesale accounts, we deal with a lot of farms who sell to restaurants, they sell to school systems, they offer credit, typically anywhere from 15 days to 45 days. A lot of them are 30 days. But tracking those receivables. So again, if in the course of the year you sold $715,000 worth of product to schools and restaurants, and if in any given month your accounts receivable was 65,000, when you divide 65 into 715, that means your receivables were collected on average of 11 times a year. Okay. So divide 365 by 11, and that means you're collecting your receivables on average in 33 days. So is that good? Is that bad? It depends. Can you afford it? Can you afford to carry someone on average for 33 days? So again, all of these financial statements, all of these financial ratios, all of these financial calculations are being put in place to make you a better manager, make you a better manager of the financials on the farm, make you a better manager of dealing with wholesale accounts. And again, for you, 33 days may be good, it may be bad. It depends on your operation. Is collecting your receivables every 33 days, leaving enough money in the operating account? So again, managing cash flow and looking at your bank balance on a regular basis is critical. Um, so in managing receivables, how do you speed up collection? And you probably see some of the vendors you deal with, some give you a discount if you pay in 10 days. Uh, so you could implement that. I know typically if I'm dealing with somebody, an oil company, a gas company, and they're giving me um, a discount to pay, if they give me 2% off to pay in 10 days, I pay it in 10 days. So again, you can do the same thing. If you need to speed up collection, offering a discount may work. And then what do you do with the ones that are overdue? Uh, and this becomes a dilemma because so many of you are small family farms, and you know the people you're selling to, and often it becomes hard uh, to put pressure on. But you want to make sure you've appointed somebody uh, on the farm who's going to be the enforcer, who's going to be the one who's going to make the collection calls and say, "Gee, we'd like to keep shipping you product, but you have 3 months, okay?" Because this impacts your cash flow. It impacts how much money you have to operate. And don't forget when you're dealing with uh, and I keep using restaurants and school systems. They're common uh, buyers that we see with farms we deal with, but it could be anyone you're selling to. But don't forget, they're managing their cash flow. So some of them are holding off paying you as long as they can. So keep in mind that keeping track of your collections, having someone making the calls to get money in when it's due, these are important things to make sure that you're maintaining good cash flow. You don't want to be spending more money because, again, if you're relying on a line of credit and you have to hit your line of credit because your accounts receivable aren't coming in on a timely basis, it's costing you now. You're paying interest. So it's costing you to carry these accounts. And often, small farms we deal with find out initially they think it's wonderful that they're getting these wholesale accounts and they think that they're going to make more money, but sometimes they end up weaning themselves off of wholesale accounts. So it's what works for you, what's right for you, and do you have a good enough structure to enforce collection of receivables? Because that's critical on cash. And we've been using cash flow in the general term, cash flow is all of the revenue coming in, whether it's cash, checks, debit, credit, cards, everything flowing through. But now I just want to spend a little bit of time on cash because some of you do have farm stands with cash registers and this cash still coming in. And some of you are outsourcing different portions of your accounting function. Uh, so you want to make sure that you never relinquish full control. And what I'm speaking about first here is your operating account, bank statements. You don't want to necessarily have someone else doing your accounting and they're also receiving your bank statements and they're also able to sign checks. And you never see bank statements. You're never looking over what's being paid. That becomes very dangerous. And the heartbreaking horror stories we've seen on small farms, someone taking advantage of that and getting into the operating account. And no one ever does it with evil thoughts. It's always somebody has run into a problem. There's medical issues in the family. They have a gambling problem. It's always something like that. And they have control of the farm's account and they see all that money sitting in there and they decide they're going to borrow it. And they're going to borrow it and pay it back next week when they hit at the casino. And of course, next week they don't hit. So be careful how much control you give up. And again, a lot of farms have good working relationships with bookkeepers, accountants, who they outsource portions of the accounting function to. And that's perfectly fine and good. But make sure you're still seeing the bank statements. Ever give up full control. And certainly outsourcing the reconciling of the bank accounts. That sounds like a good idea and it can work fine. But every now and then you might want to say, you know what, I'll do it this month. Okay. So segregating the duties, making sure one person isn't making all the deposits, writing all the checks, balancing the bank statement every month, doing everything, and you never looking at it and you thinking, this is wonderful. Wow, this is sweet that they're taking everything. You're opening up yourself for some possible heartbreak. So keep at least a finger or a toe in the financials when you begin to outsource. Make sure you have that segregation of duties. And even in the farm, do you have multiple people doing different financial duties? Because again, Jacqueline and I could tell you heartbreaking stories of things that have happened on family farms where mom or grandma or uncle had a problem and they were skimming money out of the operating account. So make sure that one person doesn't have full control. That happens when one person, either internally or externally, has full control. So again, the main premise of this seminar was to make you a good manager of your business because you know how to create and read a balance sheet and a cash flow statement and an income and expense statement. But that's just a piece of it. You also keeping an eye on what's happening financially, even though you're spreading responsibilities. Uh, make sure you don't have, make sure you haven't relinquished full control, financial control. Because again, being a good manager of your agricultural business means you know what's going on. You know how much money is in the bank on a day. Okay. And then when it comes to uh, the actual cash in the cash registers, in the farm stand, make sure you have controls there. Um, boy, I often, when I'm addressing this, when we're having the course, the full course, I'll talk about the valuable lesson I learned uh, when I owned a package store with cash. Um, do the math. If someone is slipping $100 a day out of the cash register, and you're open every day of the week, do the math and see what that comes to in the course of a year. And all of a sudden, a year later, when you finally figured it out, because the amount grew to an amount, whoa, this is affecting profitability. Well, then it's too late. So having controls on cash, uh, having when different people are coming in and out on the cash registers, with having them prove out, making sure you're looking at cash register tapes. Are there any gaps? Just looking and make sure you have good control on the cash in the farm stands because cash is so enticing for a lot of people. Okay.